Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for April 26th, 2022. I'm happy to be back. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Ned Damon, who's our Principal Data Scientist, and Dean Croak, who's our Principal Industry Analyst. Good morning, gentlemen.
Good morning.
Thanks for holding down the fort, Dean, last week.
Yeah, we did a pretty good job, I think. It's not the same when you're not here, but I think we did a pretty good job.
It's a kind way of saying better, but yeah, we've got I was going to order a custom freight boggle, freight alarmist boggle, where you just pop it and it tells you whether we're in a recession, a black swan event, a bloodbath, and it just didn't come in time. Maybe it's a shipping issue. Maybe it's the Shanghai lockdowns.
Maybe that's Susan's fault.
I sent one to Chattanooga too. But in that case, we're here every week talking about things that are happening in the freight market, or you're not talking about bloodbaths and freight recessions and black swans, just the facts, just the data, blended with our expertise and what we see happening. We do have a lot to cover this week, so I'm going to jump right into the key points of the week because I want to save as much time for Dean as possible. So spot rates are down again. Awful pun. Reefer cooling off the fastest. Get your laughs out now. Dry van contract long haul loads moved down 9%. Equipment posts are still at 2019 levels, but load posts are at 2018 levels. So this is going to be an interesting dynamic to watch as we look to our load board activity to try to get an idea of how the spot market is reacting to all of these forces. Produce season off to a slow start. We're going to go into more detail about that towards the end. And then I think a lot of people are talking about the Shanghai backlog. I think Dean's going to walk us through what's important to pay attention to there. And without further ado, I will turn it over to Dean to walk us through the market update. Dean?
Yeah, thanks, Ken. Let's get started with the dry van sector this week. We'll have a look at the load to truck ratio for each equipment type first. Last week in dry van, as Ken mentioned, we've got some interesting trends occurring or reoccurring. Load post volumes last week actually reversed course. They increased by 12% week over week in dry van. That's after almost 2 months of declining weekly volume. So a little bit of a reversal there, which is interesting to watch. Equipment post decreased slightly, a little bit of a tightening of capacity on the equipment post front. As a result, the load to truck ratio increased from 3.02 to 3.47. In the refrigerated sector, very similar outcome in terms of how it appeared with dry van last week. Load post increased only by 2% though, so not a big upward movement. Equipment posts remained relatively flat. Load post volumes in the refrigerated sector are probably affected the most by the slowdown at the moment, down not 29% year over year and 13% in the last month as reefer capacity continues to loosen. Equipment post levels are about 2019 levels. Last week's load to truck ratio increased slightly to 5.99. And in flatbed, load post volumes are up 6% last week, still down 18% in the last month and about the same amount down compared to this time last year. Volumes are tracking closely with 2018 levels, as you can see on the chart. And of course, 18 was a flatbed market that was booming, driven by a robust industrial economy. As a result of the movement of the two indices last week, the flatbed load to truck ratio increased to 64.03. Having a look at our market condition index, we'll start off on the West Coast. In Los Angeles, load post volumes are up last week, which was a bit of a surprise, up 12%. Part of the reason, as Ari Ash has reported in the Journal of Commerce, railroad capacity continues to be impacted by labour and chassis trailer shortages, especially further inland in landlocked Chicago intermodal terminals. As a result of some of the capacity constraints on rail, loads moved by truckload carriers last week increased 2.5% between Los Angeles and Chicago. Capacity on the truckload side continues to loosen, though. Even though volumes are up, spot rates have dropped on that lane by 46% or $1.51, excluding fuel, since December, to $1.78 a mile this week. That's a pretty low number compared to where we were this time back in September, October, when things were booming. Even though loads moved dropped 2% between Los Angeles and Phoenix, another lane that's been heavily connected to imports from Asia, capacity tightened, increasing spot rates by 26 cents a mile to a 7-day average of 386. That's around 5 cents a mile lower than this time last year. Having a look at the East Coast markets in Brooklyn, volumes jumped 19% last week, spot rates up 8 cents to an outbound average of 251. Brooklyn Portland to Atlanta, about 850 miles. Spot rates dropped on that lane to an average of 229. That's down 34 cents a mile. It's still 27 cents a mile higher than the previous year. And next door in Elizabeth, probably the largest market on the East Coast, capacity loosened again. Load post volumes were down substantially. Spot rates dropped for the fourth week in a row, now under $2 a mile. At $1.94 a mile in the Elizabeth market. And on the busy lane between Elizabeth and Atlanta, it's one of the high volume lanes we see continually. Rates plunged to $1.85 this week, dropped 68 cents a mile from the March average. Spot rates on this lane are now 28 cents a mile lower compared to this time last year. Having a look at our refrigerated sector, you've heard about the additional screening that was going on the southern border. According to our partner Forkites, truck movement volumes in Texas last week are still down about 5% compared to the prior 2-week period. So capacity's coming back to the market after some of those market commercial zone crossings have started to ease. But what did happen was carriers that were caught up in the far Texas and Laredo crossings diverted their capacity to El Paso, Nogales, even further over to Otay Mesa, over on the West Coast. So what happened in those markets where the congestion was diverted to, rates were up by about 10 cents a mile. Capacity tightened in those markets up to about 257 cents a mile, excluding fuel. That's after being flat for the prior month. So a little bit of a ripple effect there, but things are returning to normal. Out on the West Coast, capacity continues to tighten, albeit very slowly. Spot rates in California increased for the third week in succession. They were up by just 3 cents a mile to a state average of 253. Outbound spot rates in the larger market, Ontario, that's the second largest freight market in the state, increased by 10 cents a mile to 289 last week. But in the largest produce market in Fresno, in California's Central Valley, capacity remained flat at 233 a mile for outbound reefer loads. Different story on some of the longer haul lanes. One of the benchmark lanes I watched that's handled by a lot of teams that run dedicated capacity back and forward, Fresno to Hunts Point, New York, to the large produce markets, about 3,000 miles. Rates are up 19 cents a mile last week to an average of 219, but that's a whopping 68 cents a mile lower than this time last year, as the California produce season is off to its slowest start since 2017. We'll cover that a little bit later in the show. Further south in San Diego, a report dominated by banana and pineapple imports at the moment from Guatemala, Ecuador, and Costa Rica. Capacity tightened for the third week in a row. Spot rates up 5 cents a mile to 288 for outbound loads. And in Florida, capacity tightened this week. Even though produce volumes are down around 11% compared to this time last year, out of Florida, reefer spot rates jumped by 18 cents a mile to $1.95. One of the main reasons is a lot of reefer carriers took the week off to attend the annual 75 Chrome Shop Big Rig Truck Show. It's a 3-day event for a lot of specialized produce carriers that run in and out of Florida. They have to take a complete week or even more off to get their trucks ready for the show. A lot of capacity was off the road, even though some of those trailers were loaded. A lot of the capacity was sitting idle for the best part of a week. Typically results in capacity tightening on long haul lanes out of Florida when this event happens each year. Miami to Boston, rates are up 20 cents a mile to $2.47. Miami to Hunts Point, New York, up 15 cents a mile to $2.60, which is about the same as it was this time last year. And having a look at our flatbed market condition index, we'll have a look at down on the Gulf Coast in Houston. It's our largest market. Rates increased 5 cents a mile last week to an average of $3.08. Load post volumes were up 25% in that market. Although loads moved on the high volume lane north to Fort Worth, that's the number one lane out of Houston, they were down by 3% last week. Spot rates were up 27 cents a mile above the March average to $3.75 this week. That's almost $1 per mile higher than the same time last year. Loads from Houston to New Orleans were also down 4% week over week. But in contrast to the Fort Worth lane to the north, spot rates dropped to $2.73 a mile, or about the same as they were this time last year. Again, capacities continually tight up in Medford, Oregon, and the Pacific Northwest. Load post volumes were up 13%. Spot rates were up by a similar amount to $2.89. And in Medford to Stockton, one of the busier lanes there, rates dropped to $4.22 a mile after averaging $4.43 per mile in March. So a little bit of loosening capacity on that busy lane to Stockton, just outside of San Francisco. Another popular lane out of Medford is Phoenix. Capacity was tight on that lane. Rates up 8 cents a mile to an average of $3.54, or around 60 cents a mile higher than this time last year. So some pretty good rates for carriers on some of those busier lanes. Capacity seems generally tighter in flatbed compared to the other two modes. That's confirmed by some of our year-over-year looks at spot rates. On the dry van side, the slide continues as dry van spot rates dropped another 6 cents a mile last week to an average of 2.16 excluding fuel. That makes it 14 straight weeks of declines, with spot rates now down 62 cents a mile year to date and 12 cents per mile lower than the previous year. That's as of yesterday. And compared to non-pandemic years going back to 2016, last week's national average is about 62 cents a mile higher than the average of $1.50 a mile for this time of the year. Having a look at refrigerated sector, reefer carriers have seen the national average spot rates plunge by about 23% or 73 cents a mile so far this year. We don't appear to be done yet. Rates have dropped another 7 cents per mile last week, and for the last 2 months been plunging downwards or steady, and now sit at about 2.45 excluding fuel. Of course, driving the drop in spot rates is the California produce season. It produces about 60% of our fruit and veg each year. We're going to cover that shortly. And in flatbed, wrapping up our weekly market update, flatbed spot rates have been decreasing ever so slightly for the last 3 weeks. They were down a penny per mile last week. The national average is now 2.69, excluding fuel. It's 11 cents per mile higher than this time last year, and about 16% or 38 cents a mile higher than this time in 2018. So that's it for this week's market update. Remember, if you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report, which will be out on Wednesday evening. Over to you, Ned, for the short-term forecast.
All right, we're going to be beginning with dry van. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our forecast models. We're going to begin by talking about Ratecast. Ratecast has not been performing well recently. It's still expecting that sort of normal seasonal behavior will assert itself and will pull out of the fall. It's expecting rates to stay more or less constant for the next 3 or 4 weeks, and then rise a little bit as we head into the normal May seasonal pattern. In contrast, the short-term model in red is expecting that the fall will continue basically without interruption through the next 5 weeks, dropping by about 30 to 40 cents a mile over that period, which is a little bit grim for people who like high spot rates. In the middle, we have our two blended forecasts, which are mixtures of the two models in different amounts and in different ways, gold and silver. The blended forecasts are expecting the fall to continue, but things to level out as we head into the early part of May, with rates stabilizing at around $1.95 a mile. Reefer is also pretty grim news, beginning in blue with the market rates observed by DAT. And then off to the right, you can see our forecasts. I'll begin with the short term, which is again expecting the current slide to continue unabated with only small seasonal and day of week disruptions, ending at about $2.05 a mile as we move into the later part of May. Ratecast is expecting normal seasonal patterns to reassert themselves. We'll talk more about that as we head into the IQ question of the week, but you can see that it's expecting rates to rise by about 10 cents, as you would normally expect moving in through May. The blended forecasts, which are mixtures of these two forecasts in different amounts and different ways, are in gold and silver, and they are expecting the fall to continue but sort of level out, stabilizing at about $2.25 a mile as we move into the later part of May. Finally, in flatbed, we have a little bit more model agreement, which makes my heart a little bit happier. In blue, you can see the market rates observed by DAT. And then off to the right, you can see the Ratecast model in green is expecting a little bit of up and down wiggle, with rates ending about 3 cents a mile higher as we move into the middle part of May. The short-term model in red is expecting a little bit of a slide, rates dropping by about 4 cents a mile, as we have the continued drop being mirrored in the others, although the severity and the depth not quite being mirrored in flatbed. The blended forecasts, which are mixtures of the two in different amounts and in different ways in gold and silver, are kind of spanning the middle space, although they're leaning towards a small uptick as we head into that middle part of May. And with that, we are on to our IQ question of the week, which is, what impact will the slow start to produce season have on long-term reefer rates? And we have a very useful chart that will hopefully illuminate our discussion.
Dean?
Yeah, one of the things we've been looking at in the produce market is, the start of produce season. As you know, we're sort of off to the start of the produce season on the East Coast, with watermelons coming out of Florida. Some of the produce are starting to come out of southern Georgia, like Vidalia onions, peaches are coming online. So we're starting to see that warm up, literally. They had a cold start this year, but sort of more alarmingly is the truckload volumes coming out of the West Coast. Why it's important, I think, is that we're clearly off to a slower start, as you can see from the red line there in the chart. This is the weekly truckload count from the USDA. Of course, there's a lag in contributions, so keep that in mind as you look at this chart. But compared to previous years, right now, as we sit at the start of April, volumes are clearly down compared to all of the previous years. There's a few things going on that I think are worth talking about. Rates are, as I covered earlier in the market update, rates out of the Fresno market are somewhat flat this week. They're not climbing like we'd normally expect to, although some lanes are a little bit hotter than others. California's in the middle of a 22-year mega drought. And just this last couple of weeks, federal water officials said that a lot of farmers are not going to get their water allocation this year. I mean, just last year, according to the University of California, they fallowed 395,000 acres of farmland last season because of water restrictions. And they're now saying that the current water levels are the lowest going back to 1858 and expecting it to get worse. So water is a really big issue in the California market. That is clearly affecting farmers. When you talk to some of the growers, they're clearly not planting as many acres as they would normally do in terms of new crops. They're struggling to water the existing trees that they've got. In the citrus market in particular, which is sort of where I'm leading to, one of the things we've seen in the citrus crop is a change in the seasonality, and that's impacting our year-over-year volumes out of the Fresno market in particular. I think citrus is about 17% of volume that comes out of the Central Valley. It's a huge amount of truckloads, but the California Citrus Committee said that the 21-22 season will be down about 22% from the previous year. Now, that equates to about 17,000 fewer truckloads this year. Mandarin crop will be down about 45%. That's about 5,500 fewer truckloads out of Fresno. Some of the big reason is we've seen a change in seasonality. Normally, we would see in the USDA data a spike in citrus crops, sometime December, January. Last year, it was late in February in terms of the peak. But the season changed last year. There was a drop in production, which was attributed to a very heavy crop that extended well into August. And due to the larger size crop, fruit remained on trees a lot longer than normal, which negatively affected the current year's crop size. So we had a heavy crop last year. A lot of growers' fruit wasn't harvested last year. The season was extended, and that's pushing out the seasonality right now. So some of the reasons for it, obviously water is a big factor, but we're seeing a change in seasonality. The volumes that we would normally see around now coming out of that area, we're not seeing. And but there's still time for it to pick up, right? So even though I think we'll see lower volumes of acres planted and lower production, we've still got a ways to go before we get to that typical seasonal peak around the middle of the year. So all is not lost, but volumes are certainly way down coming out of the West Coast as we sit today.
Yeah.
Do you think we'll still drive towards the 4th of July, Dean, in terms of, I mean, that was kind of typically where you'd start to see that seasonal inflection back down to being a bit slower?
Yeah, I think growers will still aim for some of those seasonal sales that they target their crops for. I think that we'll see lower volume and definitely higher prices. That's certainly one of the outcomes. But we'll see lower volumes on the truckload side. But we talked about this last week, Ken, whether we'd see reefer rates materially increase between now and July 4. I said on a Sirius XM show last week that my best guess is they'll sort of bounce around but remain relatively flat. I just don't see enough volume in the market to make that material increase that we normally see around Independence Day.
Yeah. I wanted to note that because of the way that the Colorado River works, especially with the water sharing, if there's not enough water in California, that's also going to mean that there's not enough water in Colorado and in Arizona, which is going to impact a lot of nut growers.
And even I read this week that Nebraska's having the same problems. They're looking to get water from the Colorado River also. So we've certainly got some drought conditions going on that's impacting growers. Yep. Yeah.
So is it a blood orange bath? Anyone? All right.
Only if
I'll
you're
see
paying,
myself out.
Ken.
The door's over here.
I talk to some growers and brokers, and I talk to truckers all the time who are running back and forward. The guys that are dedicated to running produce over in teams and seafood back. They are seeing much lower volumes. Anecdotally, we're seeing they're telling us we're seeing lower volumes. They're telling us it's off to a slower start. So there's something going on over there that's going to impact the reefer market. I don't know whether it's of orange bloodbath levels, but we'll certainly.
This blood orange bath. Make sure we get it trademarked. Now, I think so. If we put produce on the shelf for a minute, today's just a show of puns. But what I'm watching, right? Because the same thing can apply to reefer. 2018 had that previous high watermark. So if you take the 2 COVID years out of play, being 20 and 21, the previous high watermark would have been right around the 4th of July. Give or take a week in 2018. And where we currently are on the dry van side, and I'm only going back to dry van because that's what I looked at before the show, we're about 6 cents above. If you take away fuel, we're about 6 cents above where we were at that 2018 peak. Different seasonality, right? And all things remaining equal, you would expect rates to find some strength over these next few weeks heading into May and June. Well, that'll be really interesting if we approach the 4th of July at 2018 levels for a lot of reasons. We talk about support levels. We talk about forward outlooks. That, to me, is something very interesting as we plot along here on the dry van and reefer side.
Yeah.
Am I alone in that, or do you all think that's something to...
I mean, yeah, there's got to be a support level somewhere, and I think the question is, or some kind of a break at some point. Like, if rates drop below like $2.75 a mile, that's going to be real rough for a lot of folks. And
it's interesting that high water mark of just over $2 a mile in dry van in 18 is about where it costs to run a truck and trailer right now. Around $2.05 a mile based on current fuel prices, which were up again yesterday. So that's I'm sort of ever the optimist. I would like to think there's some support level at that level around where operating costs are, but of course, Ken's correct. No carrier would have ever gone bankrupt if operating costs were the true low watermark.
I think $2 is probably like that's where I'll start to hit. Again, I'm not going to make a fool of myself and start rifling off midnight blog posts blaming. Never mind. I think $2 a mile, excluding fuel for dry van, is when we start to really think about things in almost like borderline irrational correction. That's below 18. Again, I think, to me, and maybe this is a little bit of a warm take. I don't think it's a super hot take. I think if dry van spot rates go back to 2019 levels, that is a bigger issue than rates at 2020, late 2021 peaks.
Yeah, 50. What have we got? 50, 60 odd cents a mile to go to get to 19 level.
Where were they? Like $1.10 nationally when the protests were happening?
Yeah, and I got them at about $1.15 now on the chart.
$2.15.
$2.15. Sorry. Yep.
Yeah.
So you got like $1 a mile to go.
Yep.
So I think that, given how the underlying real costs to operate, I think that would be a bigger story. And that's all we would be talking about. And I think you'd be having serious implications to even major fleets. Because let's remember, let's kind of dive back to what we know to be true. The contract market will respond if that happens. Shippers aren't just going to sit idly by when the spot market, if the spot market fell at 50 cents more a mile, they're not going to sit idly by and happily pay the rates they agreed to in December of last year.
Right.
They're going to put the freight back out to bid. Now, again, is there probably a larger zone of indifference where they're willing to tolerate some exposure, like forego some cost savings to protect service?
Yep.
Yeah, sure. I think that's exactly what's happening. But you're starting to see contract rates plateau. We need to have Chris Kaplis on, right? Because you're starting to see contract rates plateau a little bit. And it'll be interesting to see when they start to inch down, if they start to inch down, if spot rates remain this low heading into the 4th of July.
Just doing a linear extrapolation by holding a line up to my monitor. It looks like you'd be hitting that level if the current trends continue in mid-June.
For dry van?
For dry van, yeah.
Yeah, we'd hit 18.
Yeah.
Which was still, again, a historic, at the time, a historic, from the 4th of July in 2018 until February of 2019, we saw essentially an unprecedented historic decline in spot rates.
Mm-hmm.
Right? So let's just keep that in mind. We'd have to see a historic decline from 2021 levels to get to 18, and then we'd have to double that up with another historic decline. Again, juxtaposed against a backstop where fuel is up 33 cents a mile, and operating costs have done nothing but go up the last 2 years.
Yeah. Do you think, Ken, I mean, a lot of shippers that we talk to in our business are still talking about, supply chain disruptions, which has to be affecting lane balance and utilization levels for some of the larger carriers. But typically that market, the shipper market, is slower to react than, of course, our spot market is. I'm just wondering, where do they see themselves? Do they really want to play the market down to recoup costs and sacrifice service, given the supply chain disruptions that we're still experiencing?
I equate this like how people view refinancing their homes. I mean, how many people really sit down and do the math? And would you go out and refinance your home to save $20 a year in interest? Some people would, I'm sure. So in that regard, I'm sure there's some shippers where if they sense they can save $100 a month, they'll go out and put their freight to bid. Carrier relationships be damned.
Right.
I think what we saw after 18, a lot of transportation managers and execs got fired. That's the year General Mills restated their earnings due to transportation costs. I mean, there was like a whole ball of wax that happened. So I think the new people in the chair were probably like, I'm willing to forego some savings just to protect service here.
Mm-hmm. Mm-hmm.
My guess is that's what's going to happen now.
Yeah. Yep.
They already, but so much of this stuff happens forward, right? That's why it's hard to sell anything to a company that didn't budget for it, right? I'm not in sales, but I have friends that are in sales that would tell you, like, selling something into a budget that doesn't exist is much, much more difficult than selling something into someone had budgeted room for blank, right? So if they budgeted high and they're hitting their budgets and they're getting their service, where's the real incentive to try to drive costs down?
Right.
You could see with all the mini bids that were going on last year, and as Professor Kaplis talked about, some of those small lanes that have very low volumes weren't part of that, core bid. You could see some of those lanes getting flipped to the spot market because of just the fact that they don't have enough volume to support, or the contract carriers support them. That might be the case in some of those low volumes.
Yeah, I mean, the shorter term contract, when markets flip, immediately begins to advantage the other party and disadvantage the original party, right? So whereas brokers were getting another bite at the apple, let's just say that the old paradigm was strict 12-month bids and you went to 3-month bids. That means as the market was going up, carriers and brokers were getting to take part of that market increase every quarter. Well, now, by the same virtue, as the market's coming down, shippers are getting a chance to reevaluate and save money as the market comes down every quarter or every week, whatever they're going to.
Right.
So the same rules applied. It's just favoring one party over the other right now. So I think what you'll hear is like, okay, maybe we'll go back to 6 months, split the difference with the carriers. Or the carriers, like, if I'm a carrier, I want to lock in for 12 months right now. I wanted to lock in for 12. In hindsight, I would have wanted to lock in for 12 months on December 31st. I'd lock in for 36 months.
Right. One of the things we're seeing on social media is the return of the trucker protests, which are kind of interesting when you see a bunch of guys slow rolling on an interstate in Florida and all sorts of signs, seeing some of the messaging we saw back in May 2020 about lack of transparency. Those sorts of rumblings are starting to make their way around different social media networks, which is kind of interesting when you think about where rates are compared to previous years. Spot rates are still way above where we were in the long haul sector, but of course operating costs are up substantially, and that's where the pain is right now, especially around the fuel part.
Yeah. See, that's the weird thing to me about where we are in terms of like the narrative. To me, if I was going to take a sign and go stand in Times Square, like the end is near sign, I'd be talking about carrier costs, not spot rates.
Right.
Mm-hmm.
Right.
I mean, like we mentioned, we have like 50 cents a mile to go before spot rates, like on their own, are the thing to talk about. The fact that fuel is up, the fact that diesel's up $2 a gallon year over year and continues to like remain as gasoline has come back. The EIA just went up, 6 cents last night, 5.9 cents.
Yep.
Diesel's still above $5 a gallon. You're seeing all of the economic inflation weighs heavy on carrier operating costs, right? That is a sector of the economy that's heavily impacted by macroeconomic inflation. So to me, it's like there's a lot more reasons to be alarmed as it pertains to carrier costs than there is. I mean, interest rates to finance your truck. I mean, if we're going to pick three things to worry about right now, okay, to me it would be interest rates, because how many truckers are buying their trucks in cash? Even big firms are using debt extensively to finance capital projects. Okay, so I got interest rates, I've got fuel costs, and then I have inflation. That would be my top three. Maybe we'll end the show. What would your top three be, Ned and Dean?
I mean, I think that interest rates in not just the like cost of carrying goods side, but also in terms of the demand side, right? Like the Fed has signaled that they're going to be raising by like 2 basis points or something going forward.
20 basis points, 25 basis point chunks. I think. Yeah, it's 1/4%.
Yeah. Or more.
But the 10-year T-bill just crashed, right? It was about to hit $3. It was about to hit 3%, and it just crashed back down to, I think it's like 270 right now.
Yeah, and at that, that's going to heavily depress housing starts. It's going to heavily depress like a whole lot of consumer spending, and that's going to take a lot of the wind out of any kind of upward demand.
So you're more worried about demand.
I am more worried about demand. I think that there is a real risk of heavy demand side hits.
What's the economic term for that? Demand destruction?
Yeah.
I like that term. Yeah. Dean?
Yeah, I'm more worried about fuel costs than anything, because it's such a high input cost. It's a variable cost that can really destroy your business. Right now, it's the numbers on my spreadsheet that we've been talking about for a year. Diesel's up $1.97. Top line revenue's down $12,000 a year when you look at the change in spot rates. So my truck that was running this time last year when spot rates were $2.28 and diesel was $3.13, today at $2.16 spot rate and $5.10 per gallon, I was making 53 cents a mile gross profit. Today I'm losing 6. So I think it's such a huge input costs, and for a lot of smaller carriers, it's hard to get full cost recovery, especially those that are exposed in the spot market. And there's only so much loyalty cards can get in terms of a fuel discount at the pump. Some of them are quite substantial. But right now, I think fuel's one of the biggest things that's going to impact carriers, large and small.
Yep, I agree. All right, we're running long. I'm going to hit a couple things here real quick. We have a question about intermodal. We're going to shelf that one. We're thinking about doing intermodal as a theme for one of the upcoming shows. Impact on COVID. I think Dean's covered that extensively in his market update, so I would point you there. Dean, you have a busy week this week. You want to run through your plugs super quick?
Yeah, well, on the Rates and Lanes blogcast tonight on Blogcast Radio, I think it's called, with Chuck Snow and Rico Mohammed. Rates and Lanes is the show. Blog Talk Radio, it actually is the technical name. We're on Sirius XM on Friday morning with Jimmy Mack. We'll be talking about freight markets there. And we'll be speaking at the New Jersey Transact Conference on Wednesday evening. And Wednesday morning, as always, it's Data Wednesday, and we'll be on with Dan Deegan and DJ Flores on Sales Chatter, 9 a.m. Eastern.
All right. So with that, we're running a bit long. We will sign off. If we didn't get to your question or you have any thoughts, it's askiq@dat.com. We've been getting a lot of really great interaction there. Check us out on LinkedIn, I guess Instagram, Facebook, wherever social media is found. So with that, I'm going to sign us off for this week. Have a great week, and we will see you next week. Bye.
Adios.